Everyone loves the idea of passive income, and in fact, the most passive form of income is dividend income. The only thing that can make dividend income even better is if you receive it on a monthly basis. I even put together an entire spreadsheet to analyze all these different stocks that are currently paying out dividends on a monthly basis, and unfortunately, many of these stocks are not stocks that I would ever want to add to my portfolio. Some of them have a share price that continues to drop, and some of them have even cut or sliced their dividend payments throughout their history. When most people buy monthly paying dividend stocks, yes, they want a high starting dividend yield, but we also want those dividends to be sustainable. We want our initial investment to grow as well. So in this video, we're going to be looking at 4 of what I believe are the best monthly paying dividend stocks. Each of these 4 stocks has a high starting dividend yield, and one even reaches as high as 12%. And if you want a free spreadsheet with a list of monthly paying dividend stocks, then you can get it at the link in the description. To analyze these stocks, we'll be using Seeking Alpha and Ticker Data. There's a link to both in the description, and Ticker Data is actually currently running a Valentine's Day sale where you can get 30% off on top of the already 17% off yearly plans. Just use code LOVE at checkout. Now let's go ahead and dive in. The first stock that we absolutely have to mention when it comes to monthly dividend stocks is Realty Income Corporation, probably the most popular monthly paying dividend stock of all time. And I mean, if you head over to their website, they literally state that we are the monthly dividend company. This is what they want to be known for. And to be fair, they are very good at it. For example, if we look at the investor's presentation, we can see they paid monthly dividends for over 652 months in a row. And they don't just increase their dividends every single year, they actually increase their dividends every single quarter. They have 108 consecutive quarterly dividend increases. And they're also a member of the Dividend Aristocrats Index. What does that mean? They have over 25 consecutive years of dividend increases. So let's start putting this dividend into perspective. If we jump over to my stock screener and plug in stock ticker O, again, all this data will load in thanks to the help of Ticker Data. Now, if we come over here and look at the dividend data for Realty Income, what we can see is right now the starting dividend yield is sitting at about 5.8%. So we're talking about a high starting dividend yield. And in fact, let's go ahead and put the dividend in perspective and look at that dividend history. Again, using the Ticker Data function. If we come up here, what we'll do is use the Ticker Data function, select stock ticker O, and then type out dividend and hit enter. And what you'll see is the dividend history for Realty Income is going to automatically load into our spreadsheet. So again, we can see those monthly dividend payments don't just remain stagnant, they actually get increased on a quarterly basis. So for example, if we look at that dividend all the way back in early 2015, it's about 18.3 cents every single month per share. And if we look at the most recent dividend payment, we can see it's about 26.4 cents per share. Now, if we jump back over to our stock screener, one of the things that might have alarmed you is right here. The payout ratio is showing 291.5%. Is that a red flag? Well, we have to remember, we're talking about a real estate investment trust. Why is that relevant? Well, REITs are required by law to pay out 90% of their earnings in the form of dividends. So we don't pay attention to the earnings payout ratio in the case of REITs. Instead, we want to look at the adjusted funds from operation payout ratio, the AFFO payout ratio. So if we go over to Seeking Alpha, click on dividend safety and scroll down. Here's what we can see right here. Forward-looking AFFO payout ratio is sitting at 75%. That's pretty sustainable for most REITs. So Realty Income, a really nice starting dividend yield. They grow those dividend payments at around 3% a year, and those dividend payments also look sustainable. But here's what's also exciting. I think there's room for share price appreciation in the coming years for Realty Income. Now, one of the catalysts is going to be the interest rate environment we're operating in. REITs got hammered over the past few years because interest rates continued to climb higher and higher, making those large starting dividend yields not quite as attractive. But as we've seen, the Federal Reserve has started to lower interest rates, and they've already stated they plan on about 2 interest rate deductions in 2025, and that'll drive more people to buying into REITs, thus lifting their share price. But let's look at it from a valuation perspective. If we jump over to my REIT valuation sheet and come up here and plug in stock ticker O, here's what I want to do. If we jump over to our dividend discount model, this is valuing the stock based on how much it pays out in dividends and how much that dividend is increasing over time. We can see, assuming just a 3.25% dividend growth rate, which is in line with their average, and a discount rate of 8.5%, they're worth close to about $62 per share, while the current share price is $54.30, meaning it's around 13 to 14% undervalued at its current share price. So it should be no surprise that Realty Income is one of the top monthly dividend paying stocks. They have over 15,400 commercial real estate properties, and the credit ratings they get for their tenants actually look pretty good. We have to remember a REIT is only as good as the tenants in its portfolio. So even if some of their tenants start to struggle down the road, overall, Realty Income should be fine. Next on our list, we have a stock that's performed really well over the past year, up over 35%, and that is Main Street Capital Corporation. Now, this isn't your typical stock, and no, it's not a real estate investment trust like we just saw with Realty Income. This company is what we know as a business development company. Now, there are similarities with BDCs or business development companies with REITs. What are they? Well, both BDCs and REITs are required by law to pay out 90% of their earnings in the form of dividends. So this turns BDCs into big dividend payers. But the focus for BDCs is to focus on private market investments while REITs focus on income-producing real estate properties. So in the case of Main Street Capital, they provide financing to lower middle market and middle market businesses primarily through debt and equity investments. So if we come down here, we can see they target companies with annual revenue between $10 million and $150 million and annual EBITDA between $3 million and $20 million. Why is this interesting? Well, companies with around $10 million to $150 million in annual EBITDA or even revenue are typically businesses that are too large for bank loans, but they're also too small for large private equity firms. So this is where Main Street Capital comes in. And because these companies have so few options, they're typically willing to pay higher interest rates, which is great news for companies like Main Street Capital. So if we scroll down in this investor's presentation, here's what we can see. The long-term focus is on delivering our shareholders sustainable growth in net asset value and recurring dividends per share. So let's check out those dividend metrics. We jump back over to the stock screener, come up here and plug in Main. What we can see is Main Street Capital has a really nice starting dividend yield close to around 6.73%. So we're talking about a very high starting dividend yield. And in fact, let's go ahead and look at the dividend history. If we come up here and plug in Main, what we can see is they grow those dividend payments consistently over time and actually pretty frequently pay out special dividends. And if we jump back over to that investor's presentation, we can see Main has never decreased its monthly dividend rate. So in fact, if we look at their dividend breakdown, what we can see is these gray lines right here. Those are the monthly dividend payments that they're making. And then the green on top of it is the supplemental dividends they're paying out. Now, why would they pay out supplemental dividends? Well, we have to remember, the income this company brings in is going to vary based on a few different factors. But the main source of income is going to be their net interest income. And this is also going to be their primary driver of paying out special dividends. Many of the loans that Main gives out have floating interest rates. So when interest rates go higher, they collect more net interest income. And when they go lower, they collect less income. So for example, look right here. During the COVID pandemic, we can see there weren't really many special dividends paid out because net interest income collected was so low. But because interest rates have been so high over the last couple of years, they're making massive dividend payments. So when you understand how this company operates, how it generates income, you're going to have a better understanding of when they're able to pay out those special dividends. But regardless, even without the special dividends, they have a great history of paying out and growing dividends on a monthly basis. Now, one of the things that I do want to point out with Main is if we come down here and look at shares outstanding, we can see you are being diluted as a shareholder. But this is actually pretty typical for business development companies and also real estate investment trusts. Because they have to pay out 90% of their earnings in the form of dividends, they have two different ways that they can raise capital. One, that's going to be taking on new debt, and number two, issuing new shares. So while this does seem like a red flag at first, it's really pretty typical for these style of businesses. Next on the list, we have Agree Realty Corporation. Now, this is another real estate investment trust, and it's actually kind of known as the little brother of Realty Income. Now, if we look at the past year, this REIT's absolutely killed it. They're up over 25%, currently trading at about $73 per share. And if we go ahead and look at the starting dividend yield for this one, come up here and plug in ADC. What we can see is, again, a high starting dividend yield sitting at about 4.11%. Again, dividends paid on a monthly basis, of course. Now, here's what a lot of people like about ADC. If we jump over to their investors presentation, it's their tenants. Look at the top tenants for ADC. These are large, stable companies that likely aren't going away anytime soon. And if we take a look at the top retail sectors right here, we can see grocery stores make up about 9.4% of their annualized rent, home improvement 9.3%, tire and auto services about 8.3%. What I'm trying to point out is this is a pretty well diversified tenant base for ADC. But here's what I also love. We can see 68% of their portfolio of their tenants are considered investment grade. Again, I've said it before, but a REIT is only as good as the tenants that it holds in its portfolio. So if the health of the tenants is strong, then the health of the REIT is likely strong as well. Now, if we come down even further in the investor's presentation, here's what's impressive. They have a growing, well-covered monthly dividend. They have 154 consecutive common dividends paid, and the average AFFO payout ratio is about 76% over the last 10 years, which is pretty much in line with what we just saw with Realty Income. But we can see that Dividend over the past decade has grown at about 6% for their 10-year compounded annual growth rate. That is phenomenal dividend growth for a real estate investment trust. It's rare you can find an investment growing their dividend that fast that also has a starting dividend yield above 4%. So what is it that's allowed them to grow their dividend at that high of a rate? Well, if we jump back over to Seeking Alpha, let's dig into those financial statements just a little bit. What I want to do is look at the income statement. And again, when we're talking about REITs, we don't want to pay attention to earnings per share. We want to pay attention to adjusted funds from operation. And that's what we have right here. We can see this is obviously growing. But one of the things we also have to remember is REITs are constantly diluting their shareholders for the reasons that I mentioned earlier. The only two ways to raise capital is to take on new debt or issue new shares. So we can't just look at adjusted funds from operation. We want to look at adjusted funds from operation on a per share basis. It's important to remember that. So let's keep scrolling down. Right here, we have adjusted funds from operations on a per share basis. Look at the growth we're seeing over the past decade. They're growing AFFO per share at a much higher rate than we've seen from most REITs over the past decade. And so as a result, they've been growing their dividend payments at a higher rate as well. Now, if we look at ADC from a valuation perspective, assuming about 4% dividend growth and a discount rate of 8.5%, we come to an intrinsic value of about $69.33, which is about 5% away from the current share price. So with the huge run up in the past year, up about 25%, they do trade at a slight premium, but for the most part, it looks like this company is fairly valued, so add it to your watch list so you're prepared for opportunities. And then lastly, we have a covered call ETF, SPYI, the NEOS S&P 500 High Income ETF, currently trading at $51.88 per share, and over the past year, it's up about 5.34%. Now, there's a lot you have to understand about covered call ETFs and how they operate to understand if it fits into your portfolio. And there's so many different covered call ETFs and they each have different strategies. But let's talk about the pros and cons of this one specifically. Now, to start off, let's go ahead and look at the dividend history for this covered call ETF. Now, obviously, it doesn't have a long history because it's a relatively new fund. But the first thing we'll notice is, yes, the payments fluctuate a little bit, but not very much for a covered call ETF. For example, let's compare it to another popular covered call ETF like JEPI. If we plug in JEPI here on Seeking Alpha, we can see the dividend payouts fluctuate by a large amount. For example, look at the low right here. It had a dividend payment that's about 29 cents last year, it looks like in July, and at its high, looks like it had a dividend payment that's about 62 cents. So we typically see massive fluctuations in the payouts from covered call ETFs. But that's not typically the case as much for SPYI as we've seen so far. For me personally, I'd consider that a plus. Now, one of the things I also want to point out when we're talking about covered call ETF, look right here. They had a bigger dividend payment in August of 2024, bigger than the typical payment. Why is this? Well, we have to remember when it comes to covered call ETFs, volatility impacts their performance. These funds sell covered calls and collect premiums that they pay out as dividends. And the amount of premium they collect depends on market volatility. Higher volatility typically leads to higher premiums and larger payouts, while lower volatility does the opposite. Now, one of the things we also have to remember about covered call ETFs is they have a capped upside potential. Selling call options caps the upside potential of the underlying stocks as gains are limited to the strike price of the options. And for example, let's look at QYLD, another popular covered call ETF. They write call options on 100% of their portfolio, which really limits their upside. So for example, if we look at the past 5 years, they're down by about 22.6%. So yes, they pay out a big dividend, but we don't want to see a reduction in the original value of our investment. But this is where SPYI is different. SPYI doesn't write covered call options on 100% of their portfolio. It's typically going to be closer to around 80%. What this means is it allows the share price to move more freely with the markets, giving them more upside potential. And we've seen that happen over the past year. They're up about 5.34%. So obviously didn't rise as much as the market, but they did get to take part in the rise of the market. Now, when we look at the starting dividend yield for SPYI, it's very large, sitting at 11.88%. And in fact, if we jump over to their website, we can see their target distribution rate right now, about 12.01%. But the other thing we have to make note of is they have a large expense ratio because this is an actively managed fund because the fund managers are the ones writing the covered calls. The expense ratio sitting at about 0.68%. So yes, that is a large amount, but if you account for that in the distribution rate, you're still getting above an 11% yield. So Big dividend payments on a monthly basis, it's easy to see why people are attracted to this fund. But the last thing I want to point out about this fund is it's more tax efficient than a lot of its covered call peers. Why is this? Well, if we take a closer look at the fact sheet, look at the tax efficiency. SPYI utilizes SPX index options classified as Section 1256 contracts. Why is that important? Well, 1256 contracts are taxed at 60% long-term capital gains and 40% short-term capital gains. So what does that mean? Well, here's what we have to understand. Here's the 2024 short-term capital gains tax rates. You can see you immediately, regardless of your filing status, start getting taxed on any of the gains that you see, starting at about 10%. So for example, if you're single, you get taxed at about 10% up to about $11,600. If your taxable income gets up to about $100,000, you could start hitting 24% tax rates. But let's compare this to the long-term capital gains tax rates. Let's scroll down and look at this. If we look at the 2024 long-term capital gains tax rates, if you're single, all the way up to $47,000, the long-term capital gains tax rate is 0%. And if you're married filing jointly, you can make up to $94,000 and get a 0% tax rate. So SPYI is a covered call ETF that's more optimized for tax efficiency. So yes, it's very important to do your homework on these covered call ETFs. They're definitely not for everyone, but in my opinion, this is one of the better ones. So there you go, those are 4 of my favorite monthly paying dividend stocks. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to be able to get access to any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.